Okay, so good afternoon, guys. My name is Maurya Hanspal, and in this session, we will continue our previous sessions on the topic of financial management. So, in the previous sessions on financial management, we were talking about how to calculate the cost of capital. And before that, we tried to understand the concept of capital structure, that what exactly do we mean by capital structure. And we talked about the major two sources of capital within the capital structure. One was equity, and the other was debt. And we tried to understand that, like that scenarios into deep depth basically. Then we also try to understand about the preference shares and equity shares. We also try to understand the differences between the equity shares and the preference shares, and also we try to understand the different kinds of debt. And in debt we try to understand the most important difference between the bonds and debentures, because a large number of people still tend to synonymize both of them, but both of them are exactly different from each other, and that one thing we try to understand. Then we also try to understand the different types of debt apart from bonds and debentures. We talked about the certificate of deposits and commercial papers, like which were being used for the purpose of raising for the working capital finances. Then we also talked about the fixed deposits. We also talked about the treasury notes, which have a maturity of up till 1 year max. And further, we have a 91 days treasury bills, 182 days treasury bills, and 364 days treasury bills. After that, we try to understand the T notes, which have a maturity of more than 1 year but less than 10 years. Also, then we try to understand the T bonds, that is nothing but your treasury bonds. And we popularly call them as the gilt funds or the gilt security. So, all these things we started to analyze. To sum up in very brief, like whenever we talk about bonds and debentures, so bonds are something which are secured by a collateral, which have a collateral. Like, for example, if the borrower, like he gets defaulted in repaying the interest payments or the amount of EMI, then his assets can be seized by the lender. The assets can be auctioned away and the lender would get back the money. Whereas in case of a debenture, there is no collateral, and hence the debentures are more risky and they give you a higher rate of interest, and bonds give you a lower rate of interest. Following the basic rule of finance or stock market, that is, higher the risk, higher is the expected return, and lower the risk, lower is the expected return. And the third difference was, when a company is going into liquidation or winding up, the first preference obviously is given to the bondholders, and after that, if some money is left, it is given to the debenture holders. Then we also try to understand how to calculate the cost of capital. So firstly, we started with cost of debt. And when we calculated the cost of debt, we tried to understand the differences between the two types of debt. That is your redeemable debt and the non-redeemable debt, and we also call it as the irredeemable debt. So the redeemable debt was something which can be called up or which kind of matures up to a certain period of time. Like for example, a company might raise debt of like 1 lakh rupees per 5 years from now and pay 7% rate of interest. And that is just a basic example which I am discussing. So that 5 years is the time period. So that debt is the redeemable debt. Whereas the other kind of debt, which is called the irredeemable debt or the non-redeemable debt, which is also called the perpetual debt, is something where there is no time period for redemption, right? Then we got to know that how to calculate it. Like when we were calculating the non-redeemable debt, we basically use the formula to calculate the cost of debt. And that formula was nothing but your interest payment. I stood for the interest payments into your 1 minus taxation. T is for taxation divided by your BO, and BO is the net proceeds. And then we know that how to calculate the net proceeds. So when we calculate the net proceeds, we have the face value of the bond. If the bond is being issued at premium, we add the premium amount. If the bond is issued at a discount, we subtract the discount amount. And if there is any flotation cost, we tend to subtract the flotation costs also. And flotation cost is nothing but your paperwork and general administrative expenses, which are issued, which are used or kind of charged while issuing a bond. Okay, then we also try to calculate the like the redeemable bond, right? In that we had the whole big formula, like we had the interest rate into 1 minus taxation, plus we had the face value, minus we had the net proceeds, and we divided this by your number of years divided by your face value plus the proceeds by 2. So like this formula we try to understand in case of debt. Then after understanding the debt, the different sources of debt or different types of debt, and how to calculate the cost of the like the redeemable debt and the irredeemable debt, we try to understand the cost of the preference shares. Now, how the preference shares were different from the equity shares? Because the preference shares have the right to first dividend only when the company declares a dividend. If the company has not declared a dividend, then the preference shares have no right over the dividend also. Also, the preference shares have no right to vote. Also, like in terms of liquidation, the debt holders are given the first preference. The second preference is given to the preference shareholders, and the third one is given to the equity shareholders. And that is why the equity shareholders are also called the residual claimants, because they are the last ones. Like if something is left with the company, then only those people will get it. Then we try to calculate the cost of preference shares. Now, preference shares are again your redeemable preference shares and the irredeemable preference shares. So when we talked about KP or the irredeemable preference shares, cost of irredeemable preference shares, it was nothing but your preferred dividend divided by your net proceeds. How to calculate the net proceeds? We know it very clearly. And what is preferred dividend? It is nothing but the dividend paid on the preference shares. In case of debt calculation, we had this as the interest payments, because the interest payment is not done on the preference shares. On preference shares, we have the preference dividend, so we take the preferred dividend. But in the case you have the tax payments also, in that case, like you'll be using 1 plus tax and not 1 minus tax. Because on dividend, you have to pay the dividend distribution tax. Interest is tax deductible. Like you can calculate the interest tax shield, and like basically like when you are taking debt, like you get the benefit of the tax deductibility of interest. Whereas on dividend, you do not get the benefit of the tax deductibility of the interest, and that is why we do 1 plus tax instead of 1 minus tax. Then we try to understand how to calculate the cost of the redeemable preference shares, the preference share which can be redeemed after a certain time. And the formula was almost same as your debt. Right? We had the preferred dividend. In case of tax, we have the 1 plus tax. And then we had the face value of the preference shares, or the, like we can also call the face value as the redemption value, or RV. Minus you have the net proceeds, and then we divide this whole bracket by n, and we have this face value plus your the net proceeds, or you can also call it as your RV, and we divide this value by 2. Okay, and the formula was same. So this one thing we tried to understand. And then we were trying to understand the cost of equity, right? Like we were trying to understand the cost of equity. In cost of equity, we talked about the 3 formulas. The one formula was a basic one, like when we had your PAT, or the profit after tax, divided by the value of the equity of the firm, right? The second method that we talked about was nothing but your dividend in the first year. That is, you have to calculate the growth rate, that is the future rate, future amount of dividend, by using the growth rate and the cost of equity or the cost of capital as whatsoever. So since we are like calculating cost of equity, so like we'll be using KE by KE, and then D1 by P0, like P0 is the price or the current price plus the growth rate. Okay, so like these things we also talked about, and then we talked about the most important model of calculating the cost of equity. And your most important model for calculating the cost of equity is your CAPM model. The full form of CAPM model is the capital asset pricing model. So if someone asks you the formula for the CAPM model as we derived in the previous session, it was nothing but your KE, the cost of equity, is equal to RF plus you have this B into RM minus RF. So when we understood this equation, we talked about KE was the cost of equity, but RF is the risk-free rate, which is the rate of interest on government securities or gilt funds. And why it is risk-free? Because ultimately the government won't be defaulting on their payments. B is the beta, which is the proxy of systematic risk or non-diversifiable risk, or the market risk, like which cannot be diversified away, either by creating a portfolio also. This RM is the return on market index, be it your Sensex or Nifty in terms of India. And outside India, it can be some other index, like for example, NYSE, your Standards and Poor, your like Dow Jones, your S&P, or like Russell 2000. So like all these things can be there. And again, you have the risk-free rate. And the difference between the RM and RF is your market risk premium, because ultimately why you are like investing into the market index, the major concern of investing into the market index is to get a return higher than the risk-free rate, because ultimately the government securities are the low risk investments. And since they are the low risk investments, like they will be offering you a low rate of return, and that is why you are taking extra risk. And for that extra risk, you must get an extra premium, and that extra premium is nothing but your extra return. And then we talked about the 3 types of beta. That is the beta greater than 1 is your aggressive beta. That is, it moves more than the market. The beta less than 1 was the defensive beta, that is, it moves less than the market in uh, either of the directions basically. And then we talked about the beta is equal to 1, like which was the beta of the market, right? So before talking about the assumptions and all, so like if someone asks you that what do you mean by the CAPM model? So tell them the CAPM model, it establishes an equilibrium relationship between the cost of equity and systematic risk. The capital asset pricing model establishes an equilibrium relationship between the cost of equity and the systematic risk. Why? Because ultimately you are taking into consideration the systematic risk also. Only, not also, only. Why? Because we assume that the non-systematic risk or the diversifiable risk has already been diversified away by creating a portfolio. And that is why the CAPA model, it does not take into consideration your non-systematic risk or otherwise called as the diversifiable risk. So before going further with the CAPA model and talking about the various assumptions of the CAPA model, like let's talk about one thing. Let's talk about the difference between the cost of equity and the return on equity. Okay, like people tend to use them as one and the same thing. So like when we talk about the cost of equity is nothing but the return that you are expecting from your equity investments. Like for example, and the same goes with cost of debt or the total cost of capital. Okay, the minimum return that you are expecting from your investment. Like for example, if I purchase the shares of the company XYZ, then I want a certain return on my capital. So that is nothing but the cost of equity. At what cost? Because ultimately that's my cost. क्योंकि मैं एक रिस्क ले रहा हूँ वो एक्स्ट्रा रिटर्न पाने के लिए. But what do we mean by the return on equity? The return on equity is different because here you have the profit after tax divided by the outstanding shares of a company. And that is nothing but your EBIT में से interest भी minus कर दिया है, tax भी minus कर दिया है, and कुछ scenarios में अगर dividend pay करा है तो dividend भी minus कर दिया है. जब हम dividend भी minus कर देते हैं tax payment के बाद, because the order of subtraction remains your EBIT minus your interest payments. After subtracting the interest payments, the amount you get, like you subtract the tax payments, and after subtracting the tax payments, like you subtract the dividend payments. अगर dividend भी हो गया है तो like instead of PAT, like we call it as EACS, earnings available to common shareholders. I repeat, earnings available to common shareholders. Okay, so ultimately it's a ratio, it's a metric like which is used to gauge the performance of the company after an year-end performance. Like for example, like whenever you are reading the annual report of the company and calculating the financial ratios as a part of fundamental analysis, what are you like taking into consideration? Well, like taking into consideration your profit after tax or EACS in the numerator and outstanding shares in the denominator, and and saying that higher the return on equity, it is best for the company. So that's a financial metric, whereas that's a ratio basically, but cost of equity is not a ratio. So this thing must be clear to you. Okay. Yeah. Like in some of the models of CAPM models, some of the advanced models of CAPM, they tend to use some more things also. Like for example, they add an error term here. I is basically for the security. They add an error term here. This error term is nothing but your unsystematic risk or your residual risk. Unsystematic risk or your residual risk. Okay. So it is nothing but the risk that we assume to have been diversified away by creating a portfolio. But some people also think that there can be a minimal amount of the unsystematic risk or diversifiable risk also, even by creating a portfolio. Because not everyone is a portfolio manager. Even the portfolio managers also commit mistakes. So in the present day or in the real life scenario, no one can have 100% complete, authentic, and well diversified portfolio. Some minor mistake must be there, like even for like 0.0001%. Like no one can be perfect in creating a portfolio. Okay, so that is a concern why people use this. Then they use this SMB. This SMB is nothing but your small minus big ka risk premium. Small minus big ka risk premium also they use here. And why are they using this? Because they feel that a small cap company, small stands for small cap companies, M stands for basically your minus, and B stands for a large cap company or a big company. Okay, so basically they say that the small cap companies, they out to perform the large cap companies because basically they talk about that the large cap companies are the mature companies and they're already trading at a very high PB value. You're basically the price to book value. Like you have a ratio in finance called the price to book value, the PB ratio. So P stands for the current market price of the share and B stands for the book value of the company. By the book value of the company, I mean the assets of the company, the cost price minus the depreciation, and you get the book value of the company. So, for example, if the price the company that is commanding in the share market is very high and the asset that the company has is very low, it means that the company is overvalued because ultimately those assets are not supporting the high share price. And on the other hand, if the price at which the company is being trading in the market is too low and the assets or the book value of the assets that the company has is very high, it means that the company is undervalued. It means the price must be high. So similarly, when there is a big company or a large cap company or a mature company, the price to book value ratio of these companies are high. Not because these companies have less assets. These companies have assets, but why the ratio is high? Because these companies have outperformed the market. They have shown their good performances. They have good value, they have good pricing, they have good strong assets, they have good working capital, they have good profitability, cash flows, and everything. But a small cap company might be trading at a lower PB multiple. We ideally call them as multiples in fundamental analysis or the valuation purposes. They're trading at a lower multiples. Why? Because these are the small cap companies which are yet to be recognized and yet to grow. Because 10 to 20% of these small cap companies they tend to become a mid cap companies, and the mid cap companies become a large cap companies. So these small cap companies have a potential to command a higher PB ratio at a later point of time because at this time they might have assets but the price is being trading for these companies is very low because these have not been recognized by investors and slowly they would be recognized by investors. Like for example, some value based stocks, we call them some value companies. Like for example, you can have the EV theme. The EV theme was not in a boom, but somewhere in the hearts and minds people knew that EV could come because government started the initiatives and globally people also started to talk about the EV theme. So EV theme is again a value stock. Your clean energy themes, your solar power and renewable energy, or even like pet care industries on a boom. Your even animal healthcare industry is coming on a boom. Your fast food industries, your healthcare businesses. So all these companies are coming on a boom. But there is also one thing when people start to talk about these themes now, like these companies no longer remain the valued stocks. Okay. So that is one scenario that can also be taken into consideration for this aspect as well. Okay. And these small cap companies over the long term period have almost outperformed the large cap companies. And why these companies have outperformed the large cap companies? Because they have a higher growth rate and a higher potential to grow. Because the large cap companies have become the large cap companies. And obviously there might be a certain limit to grow as well. Whereas a small cap companies has a future growth and a large growth prospect because ultimately a small cap company has a prospective to become a mid cap company, then from a mid cap company to transform into a large cap company. So these things are available. And that is why the small cap companies tend to perform the large cap companies. So this kind of premium can also be included in the ratio, but this is the main aspect that you should take into consideration. Okay, like this was a deeper analysis. Okay. So when we talk about the CAPM model, the capital asset pricing model, there are a few assumptions of the capital asset pricing model. So let's just talk about that. So following are your assumptions of the capital asset pricing model. So it was like basically like it was the capital theory, like the CAPM model was in the capital theory. And this capital theory was trained by Mr. Markowitz. Like you had the Markowitz portfolio model. Okay, so what does the Markowitz portfolio model says? The Markowitz portfolio model basically says he basically we have to create a portfolio in order to diversify it, in order to have higher return for either the same amount of risk, either you must have a higher return for the same like kind of risk or same return for a lower amount of risk. So these things that he talked about. Okay. So basically the capital market theory may like he stressed on the creation of the portfolio, like he talked about the risk and return concepts and all those stuffs. The first assumption that was stated was all the investors are considered to be efficient investors who like to position themselves on the efficient frontier. So now the question arises that what do we mean by the efficient frontier? So coming back to the whiteboard, let's try to understand some more concepts now. Okay. So now an extended version Now, the CAPA model is a theoretical interpretation or a practical interpretation. But if you want to plot that CAPA model on a graph, then how you gonna do it? For that graph, you can plot it. Here like you'll have basically your risk, and this will be your beta wala risk, your systematic risk. And here you're gonna have your return. Okay, and here you have line. So it is saying higher the risk that you are taking, higher the expected return that you are getting. And it is not the return, it is the expected return. It might happen that our actual return might hurt our expectations, or our actual return might exceed our expectations. And this line is called your SML line, your security market line. Your security market line. So what exactly is the security market line? The security market line is a graphical representation of a CAPM model. That's it. So now the question arises that what is the slope of the CML line? The slope of the CML line is nothing but your Sharpe's ratio. You have a Sharpe's ratio, like it was like formulated by William Sharpe. So the formula comes out to be your return on portfolio minus your benchmark index, or the risk-free rate basically, or like any of the benchmark that you are like taking into consideration. Like for example, like if you're like investing into market, so it will be your market minus your risk-free rate over your this the standard deviation. Okay. Okay. Or the difference can be if you are like investing in a portfolio. So when you are like investing into a portfolio, then you want to beat the market. So वहाँ पे तुम्हारा benchmark will get changed to market. Okay, and further, like when we talk about the security market line, an extended version of the security market line, you have the capital market line. So when we talk about the capital market line or CML, the only difference is your SML, it takes into consideration only your systematic risk or the non-diversifiable risk, whereas CML, it takes into consideration the total risk. That is both your systematic risk and non-systematic risk. जब तुम CML प्लॉट करोगे ना, तो यहाँ पे फिर बीटा नहीं आएगा, यहाँ पे टोटल रिस्क आएगा. So we can say that this equation of Sharpe ratio is more feasible for a CML line and not for an SML line, because SML line takes into consideration only beta, that is your systematic risk or non-diversifiable risk, whereas your capital market line CML, it takes into consideration the total risk. That is when the Sharpe ratio of RM minus RF, you have the standard deviation. Okay, and that is the logic. Okay. So like this is something about the security market line and the capital market line, and this is the difference between the two. Okay, your capital market line is also called your characteristic line sometimes. Okay, so that is something apart, but like you must know the difference between the SML and CML. Going back, again plotting the same risk. We have a C-shaped curve. This C-shaped curve is called your efficient frontier. So what is an efficient frontier? In very simple language, it shows you an optimal combination of the portfolios. इस लाइन में ना बहुत सारे portfolios होते हैं, which are the optimal portfolios. The portfolios below this line are the suboptimal portfolios जो अच्छे नहीं हैं. Above this line are the unattainable portfolios जो real life में मतलब होना possible नहीं. So basically the concept of the efficient frontier is it gives you a portfolio or a scenario where you can get higher return for the same level of risk, higher return for the same level of risk, or the same return for a lower level of risk. Higher return for the same level of risk, or lower return, or a lower return. Sorry, क्या सेम रिस्क, मतलब कि रिस्क तुम्हारा सेम है बट तुम्हें हायर रिटर्न मिल रहा है. रिस्क तुम्हारा उतना ही है बट उतने ही रिस्क में तुमको हायर रिटर्न मिल रहा है. द सेकेंड सिनारियो इज कि रिटर्न तुम्हारा सेम है उतने ही रिटर्न के लिए तुम कम रिस्क ले रहे हो. ओके, बोथ द सिनेरियोस कैन बी कंफ्यूजिंग, बट याद करने का मतलब सोचो, ठीक है, मतलब कि ट्राई करो. सो दैट इज द थिंग. सो यहाँ पे लाइक यू गेट द ऑप्टिमल पोर्टफोलियोज, and here is a line that comes into place from here, your CML line. It tries to intersect somewhere here. Okay, this point is called your market portfolio. Market portfolio, or you also call it as tangency portfolio. Market portfolio or tangency portfolio, where your CML is tangent to this efficient frontier. Now, what is market portfolio? It is the optimal combination of your risky assets. Market portfolio is an optimal combination of your risky assets. मतलब इंडेक्स में risky assets जिस proportion में है, उसी proportion में you have the risky assets in the market portfolio, right? Now we can say that what exactly is the capital market line, where capital market line can be set as a combination of your market portfolio and risk-free assets. Because अब risky assets तो portfolio में है, plus combination एक risk-free assets का भी तो होगा. Because ultimately this gets divided into two parts. But this part is called as your your lending portfolio, and this part is called as your borrowing portfolio. Because यहाँ पे तुम पैसे borrow करके तुम market में पैसा लगा रहे हो, because here you have all the risky assets, उनका price भी ज्यादा है. But यहाँ पे you have all the risk-free assets, your government securities and all those stuff. And that is why we can say your capital market line can also be set as a combination of the market portfolio, which comprises your risky assets, risk-taking assets, and your risk-free assets separately. That is basically the concept of the efficient frontier, your tangency portfolio or the market portfolio, capital market line, security market line, lending portfolio, borrowing portfolio. So all these things you must know in the efficient frontier. So if someone asks you that what is the major concept of the efficient frontier, your efficient frontier gives you the optimal combination of the portfolios that give you a higher return for the same level of risk or same return for a lower level of risk. So this is a basic assumption of the efficient frontier that you should know about. And at the tangency level, like you have something called as the capital allocation line, also CAL. So it is same as the CML. CML is a wider version of CL. So at the tangency point, now even your CL becomes your CML. The capital allocation line is same as CML, so ज़्यादा confuse मत हो. Okay, so that is the thing. Okay, so that's all for today. I'll see you in the next session talking about the assumptions of the CAPM.